This is Professor Hazer again, and this is the second um, in the, well, it's really the third, but it's the second video related to actually putting these statements together. The last video, these pro forma statements from Microsoft. Last video, we had finished the income statement, and we had come to a final year net income of 95,756. Now, we had a really sort of a golden rule for putting these statements together, and that's for individual line items, if they relate to revenue, percentage-wise, if that's going to be your assumption, then always use the base formula. But if you have a subtotal, like gross margin or operating income or income before taxes or net income, always calculate it as a subtotal. The same rules are going to hold for the balance sheet. So we're going to go down here to the balance sheet. Here's your balance sheet, and we're going to use the same logic in a sense. Let's start by calculating these percentages. Okay, so people generally agree, even though there's a lot of debate when you do this sort of thing, people generally agree that current assets, current liabilities relate to sales. We're even going to say that net property, plant, and equipment is related to sales. So we'll use the base formula for current assets, current liabilities, and net plant equipment. And then for some of the sort of miscellaneous things, we'll just hold them constant. Okay, so in order to use the base formula, you need a percentage. So we're going to take cash and calculate it as a percentage of sales, and then we'll copy those percentages down. I may have done that in the first video, but I'm doing it again. Okay, so cash is about 9.5% of sales. We will freeze the sales cell so that we can then copy this, and even you just copy it all the way down here if it doesn't quite make sense. In some cases, it's just easy. Okay, so I'm going to go ahead and just take a minute. What I'm doing is making sure that all of the rows in these formulas are the actual rows I'm considering. The denominator is D14. That's going to be frozen. But I've seen instances where for some strange reason, some reason that you don't see the rows fall short. The mistaken row. So I want to make sure that all the rows there, I'm going to check quickly, correspond with the row that I'm considering. So that's D64 in the formula, which is what I want. And then you have D65 in the formula. Okay, so those look good. And I'm just going to go down to the last one here. And D76, that looks good too. Okay, so the base formula should work. Okay, remember that if for single line items, use the base formula because base formula will calculate that line item as a percentage of that year's sales. But if you have a subtotal, and there's various subtotals here, if you have a subtotal, calculate it as the actual subtotal. So we're going to have, I've put the subtotals in bold. You have a sort of a strange subtotal, total cash, cash equivalents, and short-term investments. Apparently that's a subtotal on the financial statements. So I'll add cash and short-term investments for that one. Then you have got the usual total current assets, total assets. There was no total for non-current assets. You have current liabilities, total current liabilities, that's a subtotal. Total liability subtotal, the shareholders' equity, and the total liability to shareholders' equity. Okay, so for cash and cash equivalents, we're just going to take it as a percentage of sales. And in order to do that, all you've got to do is take any previous row for which you have use the base formula, and then copy it down to the rows that you're going to calculate as a percentage of sales. So once you've got your base formula, just copy it down. Okay, assuming that your percentages over here are right. Okay, so our subtotals for the first year, the total of our cash and cash equivalents is 159,000, which is our total for June 30th, 2021. Okay, and since they're subtotals, I'll just go ahead and copy them down here. So we end up with a total of about 295,210. That looks about right, just looking at it. And I'm just going to check something here. I want to make sure that my base formula is going to be working. So I'm going to take this number, cash, and divide it by the sales revenue for 2025. I just want to make sure that I'm getting the right percentages. I just like to check it once in a while. So I'm getting the right percentage here, 9.5% more or less, 9.5%. And I'm going to go ahead and do the same thing for short-term investments just to check. It's better to check once in a while. So I'm getting the correct percentage here too. So that is correct. You'll notice that if you did the same thing for the subtotal, it wouldn't necessarily equal because it's a subtotal. Okay. Let's see. Okay, so now we've got the total cash is here. Now we've got three current assets: accounts receivable, inventories, and other current assets. So we're going to use the base formula because current assets, and this is obvious, receivables, inventories, and inventories especially relate to the level of sales. So that is absolutely correct. So we can just actually use the base formula that we used here and take that and just copy it to those three items there. For some reason or other, it keeps underlining everything. Okay, so our total current assets are going to be the total cash and short-term investments plus the accounts receivable plus inventory plus other current assets. And so for the first year, you get 212, 295, and I'm just going to go ahead and do it one more time because there's something. Plus, I'll do it the sum. It doesn't really matter. The sum of these three items. Yes, it's 212. Okay, and so I'll just go ahead and copy back. May regret using that sum later. You'll see why. Okay, so at the end of the first year, we have $393,000 of current assets. Okay, and then now we're going to use the base formula for property net, or not for gross, but for net property, plant, and equipment. And when we get into the further, we'll get further down the road toward the statement of cash flows, you'll see how important it is to use that number at least initially. Okay, that is not a subtotal, so I'm going to take the line item, the underline out of there. Okay, now the rest of these are operating lease right of use assets, equity method investments, goodwill, intangibles. I'm just going to go ahead. I don't know that I can say that those are a function of sales. You'd have to do some exploring and then, build the model that way. I'm just going to go ahead and hold those constant because I really don't know what they are. Okay, and so if you don't know what it is, at least in the initial model, keep it constant, and then you see what it relates to. Maybe it relates to your level of debt, so you build that into the model. Maybe it relates to some intention to acquire another company, or who knows, or maybe you've had some goodwill impairment or something, so you'd have to build that in your model. So that's you build simply, and then you add knowledge as you gain across. So our total assets, I'm just going to do this one at a time, are your total current assets plus all these individual assets here. Now, it may seem silly that I'm adding up all the individual assets like this, but you'll see why later on. Okay, so at the end of the first year, we have $339 billion in current assets, and we work that out, and it ends at $564 billion at the end of the fifth year. Okay, now we're going to move down here, and we've got liabilities and shareholders' equity. We've got a bunch of current liabilities, and I'm just going to assume that all current liabilities, like I've got our percentage of sales, which is pretty reasonable, at least for accounts payable. And these others, like accrued compensation, salaries payable, not sure, short-term income taxes, maybe, maybe not, but I'm just going to make that assumption, and then once again you would investigate later. But so I've used a base formula, whenever I used it for net property, plant, and equipment. I'm just going to use it for these six numbers here. Okay, so we end up with all those, and now I'm going to recheck just once again, just to check one number to make sure that the base formulas work. It should be 7%. If you take this number and divide by sales, it should be 7%. I just keep checking so that, go up here to sales, so that I know that it's working through. And so pretty much you're certain that if it works for the last year way down here, that your base formula is working. Okay, and so the next subtotal is total current liabilities. Now, total current liabilities are going to be equal to accounts payable plus current portion of long-term debt plus accrued liabilities plus short-term income taxes plus unearned revenue plus other current liabilities. So you have 84,000 in current liabilities to start with, and you end up with 156 at the end of year 5. One thing to look out for is look out for reasonableness. So, if I start with 10 billion, which is really a fact, that was my base year, and I go to 11 billion, that's reasonable. So look to make sure that your numbers are, if those are constant, that they're going up by a reasonable amount. Because if they jump, it means there's something wrong in your formulas. So far, every number looks reasonable. Okay, so there's your total current liabilities. Now, long-term debt. Now, these are more of a function, especially long-term debt. It's more of a function of future capital expenditures. If you're planning to expand and borrow money, you'd go ask management and then work that into the model. We'll just take these just to be cheap as a percentage of debt. There's a lot of factors that could go into this, and into stuff like dividend policy and those things. We're going to assume zero dividends for now. I'm going to take out these. I'm going to take out all these underlines built in. I guess I don't know why. Okay. So there you got total current liabilities, and you've got these liabilities here. Now you've got two more liabilities: operating leases and other long-term liabilities. I'm going to hold these constant because I don't know that I know enough about whether Microsoft is going to move or take out more office space or whatever they're leasing or equipment or whatever. Okay, so I'll leave those constant, and other long-term assets I'm leaving constant because I don't know what they are. And so your total liabilities are going to be equal to, your total liabilities plus your long-term debt. And I'm not summing these for a reason. I did that up with the assets, and I may regret it. But, it's equal to these numbers right there. So your total liabilities are equal to 210. And so, come over here. And at the end of 5 years, your total liabilities are equal to 374. So far, everything looks good. Okay, and what we're going to do now is finish with shareholders' equity. Common stock, I'm going to leave the same. You'd know more or less. An analyst would know if the management was going to issue more shares or have a stock buyback, whatever. So I'm going to leave that the same. Retained earnings. Now, this is key. Retained earnings. I'm going to assume zero dividends for now. But you'd actually, the way this thing is built, you could actually assume a dividend policy. You actually build a line which says dividends and then take out of the cash that the company earns. Okay, but anyway, so for right now, I'm just going to assume that retained earnings is 34, the beginning retained earnings plus your net income for the previous year. That's why you build the income statement first. Basic accounting. Okay, plus 51. So your ending retained earnings are 86,229 are your ending retained earnings for the first year. So far, everything looks like it was originally built. Okay, so you end up with retained earnings of 394. Now, I just want to verify those against what I originally did. I'm checking for what I say is reasonableness. It looks good. And, their earnings are growing pretty fast. So that's why their retained earnings are growing like that. AOCI, I'm going to leave constant because I have no idea what's in there. You'd have to look, and it's not that big a deal anyway. It doesn't seem that material. Okay, so we've got total equity is equal to total shareholders' equity plus retained earnings plus AOCI. That gives you 169,700 more or less. And so your total equity after 5 years, 478. More or less. And I'm just checking that. And so far, so good. 382, 4, good. Okay, and then total liabilities plus equity is equal to your total liabilities and there's your equity of 380, and adding up across, and then so we end up with 853. That's a growing company. Okay, notice that that's a growing company's growing at a big rate. Okay, there's one issue which you're going to have, and that's why I had the word plug up here. And the issue is, I've used my two basic rules. If something's a percentage of equity or sales, I took the base formula. If something was unknown, I just left it as a constant. That shouldn't be a problem. And subtotals, I think, from what I can tell, were all computed as subtotals. And that's really important. Compute subtotals as subtotals, or the sheet won't work. There's one issue which you always run into, and that's that your assets, notice that your assets here are 339. Notice that they do not equal your total current liabilities and equity of 380. And you'll notice that for each one of these years, like for the fifth year, it's 853 on the right-hand side, the balance sheet, and your total assets are 564. Okay, so we've got to find a way to get this to balance. And pro forma statements just about always have a plug. Now, I plug it two places, following different theories. Sometimes you plug it to long-term debt and then spread that out, see where it goes. In a valuation course, I think we'll end up, because we concentrate so much, we'll actually plug it into cash. And you're going to see that by using cash as our balancing account, it's appropriate, because every change on the balance sheet, as you learn from doing statement of cash flows, somehow impacts cash. When other assets go up and down, there's always some sort of impact on cash. Okay, so what I'm going to do is, since the plug is on the asset side, the logic of what I'm doing is I'm going to take the totals on the other side, take all those totals right there, and subtract out all of the individual line items which on the asset side, which aren't cash. Now it looks like a big formula, but it's not. And I'm not going to use subtotals, because sometimes you get into circular logic. It messes Excel up. So here's what I'm going to do. I'm going to start with my total liabilities and equity. So I'm saying that my balance sheet will have to equal 380. There's theoretical aspects here. Now I'm going to subtract out everything on the asset side that is not cash, and my cash will essentially be equal to the balance total. So I'll take out short-term investments. Don't take out subtotals. I'm going to take out accounts receivable. I'm going to take out inventories, other current assets. I'm going to take out plant and equipment. I'm going to take out all these sort of miscellaneous current assets. In a sense, I have to, but they're not going to impact change, because it's not changing. Take these numbers out here. And so what I've done is I'm saying that my cash is equal to my total liabilities and equity minus all my non-cash assets. And I'm just looking at this formula to make sure that that I'm not including a subtotal there, because then you're gonna get into circular reasoning. Let's see what we get. We get cash of 57 billion in the second year, which may be a little bit unreasonable, but you'll notice that our assets now of 380, 480 now total our current liabilities and equity of 380, 480. So we've got that going right there. Okay, and what I'm going to do is I'm just going to go ahead and take that formula and move it out here. And this says that you've got a lot of cash coming in. So I use my cash plug. It's growing. I want to make sure, first of all, that the final balance, 853, is my final assets, and 853 something, and 853 198 final liabilities. So I got my balance sheet to balance, okay, which is a step in the right direction. The assumption here is that you're making one hell of a lot of cash, but what you do is you set the model up, and then even go all the way down to the stock price, and then you start kind of looking at things for reasonableness. I would say part of the um, part of this big growth in cash is that, just looking at this, may be that Microsoft is actually putting a lot of the cash into short-term investments. Look how short-term investments are a large percentage of sales. And what Microsoft is doing, it's just keeping enough cash. It's got 13 million right there. They're just keeping enough cash on hand to operate their business, and a larger portion, and they're taking the excess, putting it into short-term investments, probably paying some dividends. I would think that's why this cash is going up, because a lot of it is what we call non-operating. They only need 13 billion to operate. Look how much in the previous year they're operating on 13 billion, and they're just stocking away 122 without paying. They're not reinvesting that in property, plant, and equipment. You don't see it there. You don't see it going out as dividends, or it's small dividend. So Microsoft is sitting on a lot of cash, and maybe that's why they have the subtotal total cash equivalent, short-term investments, because they're signaling to investors that a lot of their cash is actually being placed into short-term investments. So they're just keeping enough cash on hand in order to operate, and probably putting the rest into here. So in the next version of this model, after I've really finished the basics, one of the adjustments you probably make is to just make that cash 9.49 and maybe move part of the plug down into here. Find some way to move to not represent that all this cash right here is being used for operations. It's being used to, they're just stocking it away. They're not investing it. They're not paying it out as dividends. They're just putting it on the side for a rainy day, apparently, or maybe they're going to buy something. But anyway, the good sign here is that Microsoft has a lot of free cash right now. All they're doing is buying short-term investments. Maybe they're planning to do something else with it. Okay, so anyway, that's the balance sheet, and the main thing is that these are going to be a little complicated, but the main thing is to get that plug right, and it totaled up. And it's more important than ever that you understand the financial statements. You understand, you differentiate between the individual line items and subtotals, even especially in this case where, quite honestly, that subtotal there for cash equivalent, short-term investments could mean something. I think they are telling investors, hey, we're not putting all our cash, 13 versus 122, and then we come up with 57 as a plug. In the next iteration, they're not going to use that. They'll probably use, let's say, a reasonable number would be 16 billion for 21 operations, and the rest would move into short-term investments. So it might have been better to actually use short-term investments as a plug. We may do that in the next iteration of this. But anyway, so I'm going to stop here. And but this is fine for now. Those are the little things you see and the little things you adjust for as you build your statement. So I'm signing off. And the next two videos, next video is just going to be on fixed assets. Then we're going to have 3 more videos. We're going to analyze the fixed assets. Then we're going to do the infamous statement of cash flows, and then we'll finish up with the actual valuation, which shouldn't be that hard, actually. Okay, so signing off. Balance sheet, by the way, always takes the longest.